We're officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental the Good Property of the Week.
Wait. That's so weak, though. That week is weak. You got to come up with a new tagline, because that's
we'll see. We'll see. I am your host, Pablo Gonzalez. We don't have GC today, but we have a guest investor. We're going to get to him in a minute. We also have, as always, our community manager, our rock star in the chat, helping everybody out, Madison Lipson. Say hello, Madison.
Hello, everybody. Wow, you got it pretty easily there.
Right?
Right off the tongue.
I've been practicing.
Great. Love that.
And our guest investor today is a real estate investor, a former Wall Street stock guy over there in the pit throwing out papers. He's a acquisitions and deal maker guy for the DeRosa Group. He's the host of the Market Hunter Thursday with Hervé. He is the one man that in just one moment took me from having a reputation of a guy that can really pronounce last names to a guy that has no idea what he's doing with anybody's name. I've never been able to get back on my game, but he is Hervé Francois. Welcome to the show, Hervé.
Thank you very much, Pablo. What an intro. Very good. I didn't know that you had problems pronouncing Madison's name. That's a lot of
Such an easy last name too.
Yeah, wow.
Really overthinks it.
Hervé, you broke me, bro. Like I literally the first year and a half, I was like, Greg was like, man, you're so good at names. You're really good at names. And then the Hervé fiasco happened. And and now like I'm known for not knowing last names or first names or whatever. Right. So like
gotta write it down.
We thank the community is in the house, checking in the chat. They love you, Hervé. I can't wait to get into this. I want to welcome you. If you're listening as a podcast listener, we love you listening. I love you listening. I want to hear from you. And you should hear this right now. You're doing it wrong. Go to nyais.com, put it in the calendar, just show up one time. I promise you it's as fun as it sounds. And you're going to get your own nickname. You're going to get your name butchered by me. It's going to feel real special. And when that happens, it's in the roll call. You ready for the roll call, Hervé?
Let's go do the roll call. Roll call, man. That's right, part of the show. That's part of the show. Roll call, baby.
Roll call, baby. All right. Madison says, welcome to the Not Your Average Investor Show. Carl Thompson says, good morning, everyone from sunny Colorado. John Henning says, good afternoon, all. Drew Barnhill, the ringmaster of the Not Your Average Investor Show community, says, ip, Hervé. I like that, Drew. That's creative. Leo, who is now on my list of, I need to figure out how to say your last name, Ferraganen. God, Leo, good morning from all rainy. From rainy California. Bill Shields says, buenas tardes, damas y caballeros. Welcome, Bill Shields. Lee Bishop says, Hervé, hello, brother. Hello, Pablo. And hello, Madison. Lovely as ever. By the way, I'm not going to pronounce a single H on this entire call. So he said, hello, Hervé. Dean Curry says, part of the crew reporting in from Columbus, Ohio. Dean Curry. We got Jen Filson, the fairy godmother of the Not Your Average Investor Show community, saying, hey, JWB families, Hervé is here. We got Nadeem Shah saying, hello, Hervé. Pablo Madison, good morning, good afternoon, JWB family. Ken Moline, the patriarch of the first family of the Not Your Average Investor Show, he says, good or I gotta, it's raining finally here in California. Ken Moline, welcome to the show. I'm not sure what that was supposed to say. Louis Udnell says, morning from Milpitas, California. Who else we got? Eddie Harris says, hello from Atlanta. I don't know why I'm giving you a British accent, but it's easier to pronounce things without H's when I'm saying it in a British accent. Governor.
Atlanta, got you.
Atlanta. We got Noah Randari saying, hello, everybody. Greetings from California. And anybody else in the chat checking in? Sean Anna says, hello, everybody from Hampton Roads. Miguel Angel Sanudo says, hola a todos. Hola, Miguel Angel. Good to have you. Carolyn Moline, the matriarch of the first family of the Not Your Average Investor Shows community, says, hello from California. I think I'm going way too long on the Sergio Prieto. I always got to say what's up there. Sergio Prieto, go Gators. What's up, Hervé? He says. And Bradley Long says, hello from Jack's first timer. Bradley, welcome to the show. This is usually how it goes. I act like an idiot for about a couple minutes, and now you're going to learn a ton about real estate and real estate investors. So I hope you join us often. And now, my favorite segment of the Not Your Average Investor Show, Madison shares good news. Madison, what do you got?
All right. So it's not so much good news this week. It's not bad news like Greg always gives. It's more so a cool story. Kind of give the testament of the culture of JWB and the type of teammates we have here. So we were, after last Thursday's show, we were standing out waiting for lunch, and one of our newer teammates, Manny, comes up, and he was introducing him, talking to Gregg. Turns out Manny found JWB through a podcast Gregg did, not ours. He was, I think it was like Florida Investing Podcast, something like that. Listened to it, loved the message Gregg gave, wanted to learn more about the company, fell in love with the culture, applied, and now he is one of our newest leasing agents. So he is a part of the team here, loving the podcast. He's awesome. So I just thought that was a really cool story to share with you guys as a testament of kind of behind the scenes of the type of people we have here at JWB. So
it's an awesome story. I love the power of content. And it was the Invest Florida. I have it saved here. I got to listen to it. I actually haven't listened to it yet. Invest Florida podcast, episode 244.
Yep.
But yeah, we're out there, like the food truck's there, and he just comes up and is like, "Hey man, I listened to you on a podcast a month ago, applied to work, and here I am."
It's just like, I applied and you guys accepted. It's like, since you guys look at every single resume that comes in, there you go.
Yeah. Like, welcome, I guess. That's awesome.
That's
Love
awesome.
it.
That's a
All
great
right.
story.
That, by the way, Madison, I disagree. It's not good news. That is good
It's
news.
pretty good news.
That is
It's
good
not
news.
my
That's
normal
definitely good
news,
news.
but
It's abnormally good news.
That's abnormally good news.
there we go.
All right. I'm super impressed with the culture here. Madison, thank you for sharing that good news with us. You're good to go. Hervé, are you ready to carry this, man? We don't have GC. You think you're up for this?
Come on, man. You know this, man. Come on, man. Batman and Robin all day long. Yeah, we do this.
All right, I'll
I
be
don't know who's
Robin.
Batman or Robin. We'll figure that out at the end of the show. But hey, we got this.
Hervé, what's your story, man? So you're a sophisticated real estate investor. You're out there doing deals. What kind of stuff do you invest in these days?
I don't know if I'm not going to call myself an expert real estate investor, man. I'm in the lane of learning and growing as much as everyone else. I love to get out there and network, shake hands, meet people. As you know, in real estate, so many different ways to skin and catch, so many different, shiny nickels out there, if you want to call it that, on how to invest. I start off, I'm sure probably how a lot of people might have started off by doing a couple of fix and flips. I hated it. Will never do it again. Some people do it great, and hats off to you. But I realized not only from a work level, but also from a portfolio level, it was not the kind of real estate that I was interested in. So I was like, all right, that nickel is not so shiny for me. It's really dull. So I got to find something else, right? And, through Fortune Builders, obviously learned more about rental property investing, turnkey property investing, and got to know you guys from them. And, it was an eye opener, but it was also a head scratcher. It's like, because I'm not in Florida, I'm not in Jacksonville. I'm like, my goodness, how does this work with me being up here in the Northeast and these guys managing the homes? So, the conversation started. I got more familiar, started doing more research just in general on the topic of turnkey rental investing, right? And then once I started to get to know you guys, and we were saying it earlier, I think certainly you guys have many strengths. One of the strengths is that you are just in Jacksonville. I know you get questioned a lot. How come you guys don't replicate what you do in Tampa or Memphis or Orlando or something else like that? But I'm telling you right now, if you are a new investor, I think it's very comforting to know that JWB only manages homes in Jacksonville, because that means that they have their finger on the pulse of what's going on in the market. You guys are tied into the community. You've got the ears of the politicians. You're investing in the city, right? I can't think of many companies like yours that are investing in the city, in which they are buying homes, fixing them up, turning around and selling them to investors, and then from there managing them and whatnot. So I think that's very, very impressive. And so with my property manager at the time, so I started up, my wife and I, with JWB in 2018. So I have that, and then we'll go into the details on that, a little bit later. So if we draw a line down a sheet of paper, my portfolio of JWB homes is inside my retirement account. On the other side of that, in regards to how I keep the lights on a daily basis, I work with, like you mentioned earlier, the DeRosa Group. And we do syndications of large multifamily apartment complexes. And we target markets specifically in the Southeast. So right now we have a lot of our properties in North Carolina and in Kentucky. The head of the group, Matt Faircloth, got started 15 years ago, 16 years ago with his wife, Liz, in DeRosa Group. They start off in New Jersey and then branched off. I think we number our deals. So there's been DeRosa Capital 1 through what we're actually raising for right now, 16. But DC 8 was the first large multifamily that they started with. That was a 198 unit apartment complex in Fayetteville, North Carolina. I joined DeRosa Group in 2019. So about a year after I started with JWB. And I met, Matt at a local RIA meeting. I was telling you I like to go out and network. So I go out and I start meeting folks and shaking hands and whatnot. And I'm seeing him, he's kind of like, if you want to call it almost like a politician of the RIA meeting. He goes around and shakes people's hands and gets to know people and so on and so forth. So after, seeing him every time, for 5-6 months, we're at the holiday party and he starts asking me, hey man, what's your long-term? What do you want to do? I was like, I want to get into large multifamily. I flipped a couple of homes. I hated it. I want to get into rentals. It's all about cash flows for me and so on and so forth. And he invited me to join the company really to spearhead their acquisitions. I think that they were looking at properties all over the country. They knew that they needed the kind of hone down focus. What markets do we want to invest in? And I had told him about my, Wall Street background, being a research analyst, being a salesperson. And, so I just started applying a lot of my skill set to that. All right, what markets do we want to invest in and why? And, the one I would think common denominator, that the one understanding was we were not going to go into these so-called tier 1 primary cities like Atlanta, Dallas, Charlotte, Tampa, Phoenix, and so on and so forth, because we knew we couldn't compete there. We knew that the returns were compressing and so on and so forth. So we focused on the secondary markets, which is why we are in, let's say, Winston-Salem, North Carolina. We're in Lexington, Kentucky, the bourbon capital of the world. So it's been a lot of fun. Since I joined in 2019, we've done 6 deals. And, when you talk about large multifamily apartment complexes, 6 is a good number. I mean, that if you do 2 to 3 years a deal, 2 to 3 a year, it's pretty good. Now, obviously, that was through the pandemic as well and whatnot, which slowed things down, but then we picked it up again. So we just closed our largest deal that we had ever done 3 weeks ago. 670 unit apartment complex spread between Winston-Salem and Lexington. And then we're in the midst of a deal right now. So it's been a lot of, I've been learning like crazy. It's great because I get to keep one foot in regards to what's going on in the single family world, specifically in the Jacksonville market, because that's a big part of my portfolio. And then of course, what's going on in the multifamily world, where I would eventually like to go. And within DeRosa, if I had not gone through a career in Wall Street, I probably would have been a teacher. I love to teach, I love to educate. And so I want to develop an educational component inside DeRosa Group, and not for any crazy big fees, but just really to teach folks that are interested, really just the ABCs and the basics and how to get started. I think there's a lot of fear, there's a lot of misunderstanding. Real estate investing isn't really corralled. It's not structured. We don't learn it in the schools like we learn our other subjects as well, which I think is a major disadvantage. And so a lot of it is left up to existing investors and to ourselves to teach ourselves. And as we know, there's podcasts and videos and books and conferences. And there's coaching programs, right? And so on and so forth. So I would really like, I've done a little bit of it already. It's kind of what spurred me to do the Market Hunter Thursday with Thursday. Not necessarily educational, but really it was educational for me because I get to learn about investing in other real estate markets. Folks talk to me about their different real estate strategies and so on and so forth. I implement some and I don't others, which is fine. But I want to definitely get into the educational component of real estate, and even from there extending into the volunteering as well. So yeah, man, that's where I've been and where I am and kind of like where I like to go to.
Well, I got good news for you, bro. You're about to get right into the educational component right now as our guest investor. You ready?
Let's do it. Let's do it. Let's do it.
All
What you
right.
got?
So here's how it's going to go. We're going to throw on the property of the week. Let's hop into the educational section. This is your big educational launch right here, Hervé. You ready?
All
right.
Put me on the spot here.
Let's
Now,
go. All right. So we are
if I-
magically whisked away to
All right.
3043 Post Street, Jacksonville, Florida, 32205. Purchase price of $217,000.
For that? I'm just kidding.
What does $217,000 get you in New Jersey?
Can't see it. No. Let's put this big ass tree in front of me. What's going on?
That's right. That's right.
Whose idea was that?
Three bedroom, 1 bathroom home with a
Three
with a
bedrooms in that
carport.
thing? Come on.
Three spacious bedrooms. It's got a lease of $1,450, and it is a estimated cash flow when you use conventional financing of $102, and an estimated cash flow total ROI of 6.42%. Hervé, as you know, our boy GC, he's a prepared man. So he sent in his, what does GC love about this property? I'm going to read it off right now. GC loves that it's already rented.
Okay.
That it's cash flow positive on day one. What's not to love there? It's
Right.
got a buyer credit of 4356. And that's because right now it's under rented for $363. So the 1 year credit, what that does
12.
is
Yep.
through June 2012, it'll offset that turn expense and make the investor whole. And JWB floats that because it is in the best interest of the investor and the resident and JWB as well to keep them in that home and keep it going so that when it turns next time, you get back up to market rent. I think I'm explaining that correctly. I'm not really sure. It also had a full gut renovation done in 2017. It's located in the Murray Hill area, which I don't know how much you know Jacksonville, Hervé, but Murray Hill is kind of like the hipster spot, right? Like that's the next wave of urban renewal that's happening. So it's seeing a ton of growth with new restaurants. Like I got a bunch of friends right now that just moved there because they like to walk to like the cool spots. So it's in this like really up and coming area where young families are moving to, where like the trends are being set in Jacksonville. So that is what GC loves about this property. When you look at this thing, man, what are you looking for when somebody puts a sheet like this in front of you when you're dealing with JWB?
What am I looking for? Well, listen, I mean, obviously I always go to the table on the right. Is this thing positive cash flow? These numbers are healthy. These numbers are healthy, even on the non-recourse side, $297 a month. Probably because you're putting down a larger down payment because it's a non-recourse loan. Obviously, typically you have to put down 45-50% down payment versus a conventional loan. So listen, good cash flow and whatnot. Now, one of the things I've been thinking about a lot over the past several months, I'm sure a lot of us has, is because the price of these homes always been going up. That's the market, not much having to do with JWB. You guys obviously build a great home and things like that. But the cash flow margins have been getting squeezed a little bit, right? No big surprise. So always thinking about, what can be done, to go ahead and try to improve that cash flow kind of a thing. And so what's that rent? $1,450. Listen, this is good. Do you property management fee? And there's no HOA dues. So no HOA dues, which is a good thing. Yeah, in my perspective, right? Because I mean, that just kind of helps out the cash flow that much more. And then you have that credit, like you said, because of the difference in regards to, where the rents are versus, where the rents for the market are and things like that. So this is a 1940. Okay, hold on now. This is a 1940 build. All right, now we know. Well, now listen, we know JWB family knows this is 1940 build. What you guys have been showing for a while over the past few weeks has been new builds. Right.
That's right.
So this is a 1940 build, right? So listen, you guys renovate as good as anyone out there right now. So I'm guessing that the electric, the piping, the plumbing has all been upgraded to code and so on and so forth. I think a buyer of this house is going to have to think about the maintenance and so on and so forth. Perhaps not early on because I'm guessing it's been fully renovated. If it's just it's coming on the market for sale, but like you said, there is a tenant already living in the house, kind of a thing. So yeah, I mean that's probably something I would think about. Listen, if you want me to get technical, I mean I'm joking about the tree, Pablo, but I'm thinking about the roots. right?
Okay.
As close.
Yeah, I was wondering why you
Right.
hate trees.
Yeah, right. I
On
love
Earth
trees.
Day,
I love trees.
nonetheless. Yeah.
Yeah. But I'm just thinking, as big as that tree is, how sprawled out are the roots?
Okay.
As it's sitting as close as it is to that house, and again, it being a 1940 house. I'd love to see if you had pictures of the interior. But again, I'm assuming you guys did a great job renovating it. Looks like a new roof, at least from this photo. Someone said detached garage. Yep. Which is all fine and well. So, hey, listen, at the end of the day, like you guys have always said, and Greg always said, don't fall in love, right, with the photos, with the pictures. You know about the neighborhood. We see the numbers here. The numbers are very attractive. I'm sure leases are only going to go up. Rents are only going to go up in this neighborhood because, of the nightlife, and that's where the hipsters love to live. So, yeah, man, I am maintenance rate. I'm a buyer.
Cool.
I'm a buyer of this one, 217. I would like to compare that purchase price to some new builds that you may have. Not, and if
Okay.
you don't have, that's fine. I'm just saying, just in general. Like if I was going to do a deep dive
Sure.
on, am I going to, pull the trigger to buy this one? I would compare it to other homes that you may have in inventory that is at a, similar price.
Yeah. So, all right. So that's good, man. So you're right. A couple of things that you said. Number one, cash flow is getting squeezed and returns are getting squeezed thanks to home price appreciation and interest rates going up, right? That is the state of the market right now. If
Right.
you would have looked at this house 6 months ago, a year ago, I wouldn't have been surprised to see this house at like 190, or something like that, right? Because there has been such great appreciation, and the ROIs that we were putting out there like a year ago when we said things were going to start to get squeezed, this probably would have been somewhere about like an 8% or a 9%, right? Like with the stuff that we were showing on the property of the week was closer to that. And as the market continues to develop, I think it's pretty clear for all of us that these ROIs, these cash flows are getting squeezed. We're having to look at the 5 profit centers in a deep fashion in order to really understand it and compare it to other asset classes. So I think that's a really good point. We did say that this thing was completely gutted in 2017, right? So it's like fully rebuilt from the inside in 2017, even though it was built in 1940, right? So, and the maintenance rate down here, this is something we haven't hit on for a while on the show, right? It's the JWB data flywheel, right? This idea that because they own and operate and manage over 4,000 homes in Jacksonville, these rates are all accurate to the type of build, neighborhood, and specific things, right? Like, I don't know if when you were looking at other homes and whatnot, people were using a kind of like a table for saying, maintenance rate should be around 6% or 5% or whatever they use. If you look at the different property sheets that JWB offers, maintenance rates are accurate to the exact like style of construction and home. So while this one is like 7.5%, it's a higher maintenance rate than you're going to see in the new builds that are 4%. But the good news is all that is priced into this thing that you're buying, right?
Gotcha.
Like, I love that this is where you first went. You went to, went to the cash analysis, right? So, and we talk a lot about it on the show of like the standardization of how JWB has controlled for all these outside variables in these numbers that they create and under promise over deliver. So really, this is where you go. What I want to dive into with you, Hervé, is the fact that you kind of mentioned this. You own 6 properties with JWB. You've also done 6 syndication deals. Kind of interesting. That's your number. I'm not going to say anything about that. And but you buy them. You've bought them in your retirement account, right?
Yes.
You bought properties in this like what we call non-recourse financing.
That's right.
Yeah. You want to talk about what's different about that versus conventional return or buying it in cash?
Yeah, I mean, non-recourse. So again, typically, and I'm sure the JWP family knows, non-recourse, you're being asked, I think I said earlier, to put a larger down payment, right? Anywhere between 40 to 50% down payment towards that, right? Because it's a non-recourse loan. So in the event that something goes wrong with payments, they start talking foreclosure, they can't come, after your own personal assets. They can only come after what's in that non-recourse loan. In this situation, it would be this house, right? And so they know that there's not much more collateral behind this home, which is why it's a higher down payment as well as a much higher interest rate. So with the approved lenders that you guys offer to JWB investors, one of them, they put out, I think it's like at 7.75%, the mortgage rate that they offer you on new purchases. And things like that. And then the conventional is the conventional, right? Whatever your credit rating is and so on and so forth. They take a look at the rest of your portfolio, and that conventional rate is going to be much lower than a non-recourse rate as well. You put down a much less down payment. This is why Gregg has been pushing for so many months. Hey, go ahead and get into these homes now before rates start increasing. Think about doing your refi now when rates are still low before they start increasing, so you can use that down payment to go ahead and buy another house and so on and so forth. The thing is that this is a very good monthly cash flow for non-recourse homes. It's really good. And it's going to be higher versus if it were a newer build where your monthly cash flow is not as much because it's going to come in with a higher purchase price and whatnot. The insurance on this one may wind up being a little higher. What was the insurance? 1,006. This is a little higher when I can think about properties that I have in my portfolio, which actually is 700-800 depending on the home kind of thing. So this is higher, but it's higher probably because, again, it's a 1940 build. So that's what you're going to typically see, in these older homes, is higher insurance and whatnot. So non-recourse, it's not for everyone. It works for me in regards to my financial strategy, my portfolio. If you want, insurance rates will be arriving in your mail soon. If you want, I can go into how I started building my portfolio in non-recourse. And Lee is 100% right. Make sure you do have reserves in your non-recourse. Lee brings up a good point in that we have to remember one thing you just cannot do, IRS codes, is that you cannot commingle your funds, the funds that you have in your non-recourse account versus funds that you have, let's say, in your savings account. So any kind of maintenance expense needs to come out of your non-recourse accounts. Your rental income, your cash flows goes into your non-recourse account. You can't take money from your, Chase account or Bank of America account and put it into your non-recourse account. So complete separation. So yes, that's why it's important to have, reserves, especially when it comes to turns and things like that, which I have a couple going on this year. So this is, like I said, I like the cash flow. I haven't seen a cash flow this high. I got a spreadsheet up taking a look at some of mine. Yeah, this one is higher cash flow on versus all of my properties except one. And sure enough, the one that's a little bit higher is also an older build versus some of the new ones that I bought from JWB over the past few years.
That's interesting, man. So I want to double click on a couple of things and then let's get into that strategy that you're talking about, right?
Sure.
So the first thing I want to double click into is number one, non-recourse. That means you're purchasing something inside your retirement account. That's something I had no idea one could do, right? Like this idea that you can buy investment properties inside your IRA, inside your 401k, as long as you have like a self-directed 401k. I think it's an interesting thing to talk about.
IRA, right. Or
that's why you're talking about you can't commingle things. It just has to be in there, and you got to have its own reserves. But if you're new to the show, that's something that you can look into, which I find very interesting. Another thing that you talked about, right? Like I love that we're hitting this. Higher insurance, higher maintenance, yet cash flow and all these returns are the same because these properties are all baked to make the entire, the recipe. What you end up getting is these returns, these rates, all these different numbers and inputs are just the ingredients. And what JWB controls for is for this, the cash flow and the returns based on all the ingredients that you put into here. So I just think that that's really interesting that we went in and we're like, oh man, insurance is high and maintenance is high, but because the price is going to be a little bit lower, because the rent's going to be a little bit higher, right? Like it all ends up coming out to the same kind of recipe meal at the end, which is what JWB is selling. And then the last thing that I was going to get into is real quick, the 5 profit centers of rental property investing, which are the cash flow piece, right? That you see here. This is the monthly cash flow, the debt pay down, the idea that when your tenant is in there, they're paying down your mortgage and building your equity, the tax savings that JWB can provide, the appreciation that you get from a home, and inflation hedging. And I just kind of wanted to show the fact that we don't include appreciation rate. Now I'm saying me, like I work for JWB, right? Like I'm in the house now. That JWB doesn't show appreciation rate on this thing. Do you want to? I know that you've watched the show. You want to take a crack at explaining the whole like 0% appreciation rate, how you should factor appreciation into your long-term investing, and then we do the leverage trick, and then we go on?
Yeah, I mean, the thing is, and I know because JWB, Greg always says you guys like to be conservative, and so that's why you just kind of keep it at zero, but then you turn around and, you can show folks, hey, what do the returns look like if you take the appreciation rate up to, I think it's 4.5% for Jacksonville over the cycle, 4.4%, something like that over the cycle, right? So you can go ahead and you can go ahead and put that in. Listen, it's always fun to see. It's always great to see and whatnot. I'm sure a lot of us have our spreadsheets. You like to see what the value of your home is at any given time. So you go to Zillow, you go to Redfin, you put in the address, and boom, there's a number. Like, wow, look at all the appreciation, over the past couple of years. But this is over a life cycle. It's not a 1 year when you put in the appreciation and so on and so forth, right? But in an outsized year like you had last year, when you appreciation 10-15% in Jacksonville, something like that. Excuse me, cash flows.
Try 20, bro.
20, right? Yeah,
No.
20. So, right.
Yeah.
So, when it's time to go ahead and get that new tenant in, all of a sudden you're going to be putting that new tenant in at a much higher rent level over the next couple of years. What's impressive about this property, I got to admit, even though it's a 1940 build, and I know it was renovated back in 2017, this rent of $14.13 to $14.88, that's the rent of some of your new builds. Yeah. Right. I mean, so that's what's kind of impressive. If you have this one on top of in your portfolio, you're going to have a lower mortgage on this one because the purchase price is a little bit lower.
Yeah, man. Good breakdown. Good breakdown from the analyst.
Yes, sir. Yes, sir.
So the one thing I'm going to show is, how we talk about the appreciation thing is you don't count on appreciation unless you're in for a full market cycle, right? If you're investing long-term, if you're buying this thing for 5 years, you're better off thinking zero and like the rest is a bonus. Sure, but if you're in it for a full market cycle, history has shown, you're a data analyst, that you can count on appreciation being the same in about a 20-year period in a local market. And Jacksonville is one of those markets that's cash flow positive and has a higher than average home price appreciation, which is normalized to 4.6%. So if you're thinking long-term, you put this in here, and again, you can download this sheet. Madison shared it a couple of times in the chat, and boom, the ROI jumps to almost 24%. That's the power of leverage, right? The idea that if you're putting in just 25%, you're still getting the appreciation from the other 75%. So the actual, return you get is based on that.
Absolutely.
So, all right, Hervé, you know what I want to do, man? I do want to go into the exercise of your strategy. So what I want to do is bring up your portfolio. Let's talk through it. Here's your portfolio. You have these KPIs. Now you've invested in, all of yours have been in inside of your retirement account, right?
Yes.
So these lifetime returns that we're seeing are inside non-recourse financing, meaning that you're not getting the tax saving
benefit, right?
Yeah, the tax benefit part of it, which inflates it as well. And this is again contained inside of it, compared to the property we were just looking at that has a 2.33% ROI on that. This has been your return so far, 4.78%. You've been with JWB for a little under 4 years, right? Like 3.8 years. Mm-hmm. Lifetime net rental income in these 3.8 years of $48,581, and a lifetime total ROI so far of $58,820. How does that match up with your spreadsheet? I know that you were just referencing your own numbers and whatnot. How does that look in comparison?
Yeah, I think so. I don't track net rental income. I don't track lifetime return. I'm not gonna lie to you. I was telling you this before. I really don't care about lifetime return. I'm not a portfolio manager. You can't take lifetime return to the bank.
Okay.
Right.
So what do you care about?
But I appreciate that you guys put it there because it's nice to see. Yeah. So I focus really on cash flow. What is my net cash flow on a monthly basis on all of my properties? And I focus on that based on the strategy that I use to go ahead and build out my portfolio at JWB and how I can go ahead and continue to accelerate that cash flow. So those are the more important metrics for me. The lifetime total return, I haven't been able to dip into because it is in my retirement portfolio. It's nice to see lifetime net rental income. And I could probably only say to that figure that, it's in the black, it's positive, right? So none of the properties are in the red, none of them are negative, which is outstanding, right? And that's, I think, the power of really working with you guys and how you guys manage properties and, put them together and so on and so forth and, renting them out. So seriously, kudos. I'm just not, I'm not trying to blow smoke. That's kudos. I wouldn't have been able to do this by my damn self. Let's just,
Yeah. Okay.
let's just
Yeah.
get that on the way.
I mean, we were talking about this before the call, right? Like,
Yeah.
this, how you approach this thing as like a total, like right now, these are your 6 properties, right? Like,
Yep.
you were kind of giving me like a comparison of just like how passive this is versus your Netflix stock. You want to kind of, how you see that piece?
I said what you said?
Do you want to just kind of like tell us how you view this
Yeah.
thing as a passive investment?
Absolutely, absolutely. So the method I have been using is that, as is shown here, 5727 Carnation was bought cash. The other 2 were bought at the same time, 1413 Nelson and 71 and Matthew Street, right? So those 3 were bought right around the same time. And it's pretty much the C3X method, which is taking the cash flows of all 3 properties and using that to go ahead and pay down the principal balance of the house that has the lowest mortgage balance. So I've been doing that since 2018. With that, of course, what results is that the equity just completely skyrockets in that house, that you're accelerating the principal pay down.
You blew my mind twice. This was the first one, right? Like the
Okay,
second thing you're
okay.
about to say is even more mind blowing, right? But the idea that you bought these 3 properties all in the summer of 2018.
Yes.
And by May of 2020, just 2 years, you
Yes.
were able to take enough cash out of those to buy a 3rd property. And then just a year and a half later, you were able to take enough money out of those to buy 2 more properties, right? Like no more cash
Right.
in. The cash that came out of your retirement account originally were for these 3 properties.
Right.
And in 3 years, 3.8 years, right? We were just talking about, you've been 3.8 years.
Sure.
Your 3 properties have had 3 babies, right? Like
Yes.
without you having to put anything else
babies.
back into it.
That's
right?
right. That's right.
So that to me is freaking incredible, right? Like I did not know that. I'm not a sophisticated real estate investor. I had no idea that this is feasible at this speed, right?
Yes,
So
yes.
that's really fascinating to me. And you did this by what Lee put in the Q&A. You're using the C3X method, right? You are
Exactly
strategically looking at the house that has the least amount of equity to pay off, paying that off with all the, instead of, right? So like my portfolio, I have 2 homes and I'm just taking and paying. The rent comes in from one home, it pays off my mortgage and I keep the cash. The second one, rent comes in, pays off my mortgage, I keep the cash. You're taking the 3 rental payments from the 3 people, looking at zeroing in on one mortgage note and paying that down as quickly as possible to build as much equity as you can to take out that equity to buy more homes.
That's right.
That's incredible, man. Is that just your analyst brain? How did you decide to take action on that? Was that from the beginning you were going to do that strategy?
I mean, here's the thing is that it really helps to have a goal. I didn't necessarily go into my first purchase or first 3 purchases with JWB saying, I have a goal to own 10 houses or 5 houses. I did not have that goal. I went in saying, let me see how this works. I get it, the market, JWB. So I did all that background. So I was like, okay, then I committed. But when I committed, I didn't have necessarily a goal on number of houses I want to have or certain number of monthly cash flow. I just wanted to see how, and so as it grew and grew, then I started studying C3X and I was like, wait a minute. So probably 2 to 3 months after I purchased the first 3 homes, I started doing that accelerated principal pay down method. And sure enough, man, it's a beautiful thing when you get that bank statement in the mail and it shows you how quickly your mortgage balance has dropped because you've accelerated the principal payment. It's an amazing thing. Then I'm thinking in my head, all right, 75% loan to value is what the bank typically wants, sometimes even lower than that for non-recourse or whatnot. So that's what enabled me to go ahead and purchase the home on Francis Avenue. And all the while, I was just accelerating the principal pay down on one home, Carnation Road. When it got down to, I think I had a $20,000 or $30,000 balance left, on Carnation Road. I said, let me go ahead and do another refi and whatnot. And oh, by the way, in doing these refis, Pablo, you don't need to use the approved lenders of JWB for the refis. Now, I remember when
let's get into that. Let's get into that. Yeah,
absolutely.
So you got this strategy kind of baked in over time.
Right.
Now you've unlocked this other thing, right? So I'm gonna set the context, and it's the idea that one of the most questions that we get often on this show is this idea of like, why can't I use my own lender? Why does JWB have only like a select group of lenders? Is it because they get a cut? Is it they're not? Gregg always explains this idea that
exactly
not every lender knows how to close this deal. Right. So they have these people that they know that can close the deal that de-risks the closing for the investor and for JWB as well. But those they're not necessarily the ones with the best rates. They're just the best likelihood to close, and it's already baked into the thing that you're buying. But you've discovered something else. Go.
Yeah, I mean, pretty much that you don't, when it's time for you to do a cash out refi on your homes, that you do not need to go back to the approved lenders of JWB to do that. Then it's just a matter of finding a lender that is willing to go ahead and do that cash out refi. Now, I'm not going to lie. That took a lot of research. That took a lot of homework. I actually had to go through a mortgage broker. Now, when Lee was on, I think a few weeks ago, I think he had said something that when he had done his refi, he did go back to the approved lender. I wasn't sure you could do that or anything. I remember going to one of the approved lenders, asking them if I could do a refi. They had told me no. So I said, okay, cool, I get it. Let me go ahead and find another approved lender. I'm not going to lie, Pablo, in the spirit of full transparency, there are fees associated with going through a mortgage broker that's going to find you a lender that will do a refi on a home that's inside a non-recourse. That's why, some lenders don't want to touch it because it is non-recourse kind of a thing. But other lenders are okay with it. And you're probably going to see the bigger ones that have, bigger capital balance and so on and so forth. So yeah, I used a broker, found the lender, again, paying the fees. But to me, the fees was not going to slow me down from doing this process, because in my mind, I'm thinking, this is going to be the quickest way for me to improve my cash flow on a monthly basis. So if I want to start this process again, I can.
I mean, I can't imagine I don't know what fee you could charge me that makes me think it's not worth it to get 2 more properties without putting any extra money in. Like
exactly right. Right. Yeah. I mean, it's just the cost of doing business.
So the thing I wanted to point out there, right, is this idea that, JWB controls the transaction for the experience, but one of the things that I think people misunderstand the most, and another question we get a lot is like, who owns this home when you buy it, right? Like, is this a syndication that you're buying off of JWB? It isn't, because you have bought these 6 homes outright, and once you own the home, you can do whatever you want, right? Like JWB,
absolutely.
JWB is always going to give you some advice, whatever, but you can do whatever you want. And in your case, you figured out that like, all right, so they can give me the initial team to set it up, but once I have it, like I can go out and test whatever I want. And even though the initial lender who specializes in closing these deals was best for me at that point, right now the best thing for me is a lender that knows how to refinance this thing at a better rate. And in under 2 years, you were able to pick up 2 more properties based on having identified this scenario. I find that really, really fascinating, because I think that like, if this money were, and I know you're in the syndications also, because that has its own benefit, but if this money was like in a syndication, you wouldn't be able to like go do your own thing, because you don't like directly own it as a controller, right? So it's like a good distinction for people that are thinking, do I want a little bit of this or a little bit of that, right? Like I think that's really cool.
Absolutely. No, I mean, the cash flow is going to jump. Again, the acquisition rate at 7.75% from one of the approved lenders from JWB. When I refi, my rate will go from 7.75% down to 6.2%. That's significant on homes that are generating, $150, $200, $250 in cash flow. That's a significant drop in rates. So from doing one refi here on, let's say, Calhoun Road, I'm going to be increasing my monthly cash flows by $110 per month just on one home from doing that refi. Same thing when I do the refi for Duane Avenue on Tuesday. I'm telling you, I closed on these on February 1st. If I could have refied back on February 2nd, I would have. But
Yeah.
the lenders and appraisers
Yeah.
and I
Yeah,
got to
yeah.
wait for all that crap and everything.
Yeah,
And I was,
that's something I haven't said. You're about to refi something that you closed 60 days ago.
yeah,
And it's still worth your while. That's
yeah,
insane.
absolutely. And I would have refied it earlier because in my mind, I'm like,
Yeah.
damn, interest rates are going to go up. And I know these lenders are going to go, oh, wow, you know, you waited too long and the rates are up another 50 bips kind of a thing. So I said, let me refi now. If we're in a low interest rate environment, I would have been able to buy myself some time. But I knew we were in a rising rate environment, so I wanted to refi right away.
All right, let's kind of give the highs and lows here of the rest of it, right? So, you know what's funny is that all these numbers, like go back to this initial number. This is 4.78% based on just the stuff that you bought. But I don't think that this 4.78% accounts for like 3 free homes. Right?
That's why I don't focus on it a lot.
So it's kind of off. That makes sense, right? So now when the numbers by which JWB tells their investors, your highest ROI here of this Carnation Road is 6.73%. That seems pretty good for a non-recourse home, and pretty consistent year over year there, right? Like, and then the lowest one is this 2.6% on Melson, which seems to have had a really like kick in the teeth 2021. Do you know what happened there?
The only thing I can think about is a turns. That's the only thing I can think about because I haven't come out of my pocket big on any of these homes. I mean, there'll be maintenance thing here or there. To be honest with you, my so-called problem child tenant was on Carnation Road, and they continue and sometimes they don't pay in full, but it is what it is. You know, it's just part of being an owner or something like that. So, and that was the one that I bought in cash. This one was using non-recourse. So 2021, just last year, that's the only thing I can think of was there's a turns.
That's interesting that you got 6 homes. You had a negative return year in 2021, and you have no idea because you're not even messing with it at all, and it's just taking care of itself.
There was never a month. There was never a month that they didn't pay rent or they didn't pay in full. That's why, you know, and that's if I'm going to focus on something, it's like, okay, you pay in full, you pay on time, you pay in full, you know, maintenance expense here or there, you know, but that's the only thing I can think of for that one.
I think it's a perfect illustration of the passive nature of this experience, right? Like I think it's pretty cool. I think it's pretty cool, man. All right, so then here are the 5 profit centers, right? You've had a total net rental income of $48,541. You got a goose egg on the tax savings because you're in the non-recourse space, right? Like you already took those tax savings when you saved that thing off of your paycheck. Right. Your total principal pay down. This is interesting, man. I can't believe that you've refied and bought 3 homes off of refis, and all your principal pay down is only $7,340. Like that doesn't, you know, that's interesting. And your total home appreciation in 3.8 years has been $268,000.
Wow. And that's over the 6 homes? Because I'm looking
that's over the 6 homes. So that is more than the price of this home that we were looking at today. That, by the way, is available if anybody wants to pick it up. We forgot to say that piece. We've been selling out here like QVC style. Yeah, man. So in just 4 years, $268,000 worth of appreciation. And then the inflation hedging. I don't really know how to explain this stuff. This is where we really miss GC. I don't know if you know how to explain this, but he's got this consumer price index of 8.5%, which I guess is like what you would be losing out on if you had it under I don't know how to explain that.
Well, yeah. I mean, the thing is, you know, so I think GC, what he's trying to show here, I'm gonna maybe peek into his mind a little bit that, you know, we get inflation right now going on at 8.5%, right? And so on one hand, you're going to see that is definitely going to have an impact on the value of your home, right? Increasing, right? I think I was reading something the other day that the average price of a home in the United States right now is $400,000, and that's up from like $280,000 just a couple of years ago, which is insane, absolutely insane. Now that's across the entire U.S., higher in some places, lower in others, obviously. So you have CPI of 8.5%. That's going to be a positive impact on the value of the home. That's also going to be a positive impact on rental income, because we know that rental income has been increasing. You're just showing that sheet on the house with $1,450 in rent at $217,000 purchase price. So those should have positive impacts on those. And folks have to think about, hey, listen, if my money was not in a rental property, and instead it's just sitting in my savings account, then it's going to lose, right? My $100 is going to be $92 next year at 8.5% inflation kind of thing, right? Because of the value just declining like that, less purchasing power. That's not the case. It can almost reverse for having rental properties and whatnot. And again, that 8.5% is not going to be the only thing that impacts the value of your home. There's going to be other metrics, but that's definitely going to be, one. So I think I was just about to use the word hedge. That is why you want to be in rentals in a rising inflationary market, is because it is a hedge of you losing the value of your dollars by having it invested in an asset that shows not only increase in rental income, but also increase in property values.
Guess what, Hervé? You just went full on educator on me, bro.
Did I? I hope I didn't.
Yeah,
I hope I didn't throw you a curveball.
That was great.
Here,
yeah, no, I didn't understand. You helped me understand that, man. That was great. Thank you for the education. And on today's show, in honor of your silent H in your name, it's edging against inflation.
Yes, it's so true. Edging, which is another word, but we're going to just pretend that you know exactly what the hell I'm talking about.
It's another word. It's another word. All right.
Yeah.
Hervé, now this is the secret sauce that GC likes to sprinkle in. First of all, thank you, Drew, for telling me that I'm supposed to compare these numbers right here and talk about like what really pops out, as in you've made $268,000 in home price appreciation, and the next biggest profit center was $48,000. So like the idea that investing in a high growth market with great home price appreciation long term, that's where the majority of your wealth comes from. And as long as it's not taking money out of your pocket, it's good. But right. GC goes as far as taking out the holding and closing costs and the selling costs to tell you what your total return would have been right now. And in your client portfolio, when you signed up as a client on these sheets, it would have said 4.1%. Your actual ROI has been 10.7% inside of your portfolio. And are they beating expectations? Yes.
Right.
So I don't know if you ever did that calculation. How does that look to you? Are you like,
I have not done that calculation, but that calculation looks very attractive. I'll take that. I will definitely take that. Not including the appreciation a lot, right? So very impressive.
You were talking about as a stockbroker, about what if in stocks, this level of risk and passivity, 10.7%. Is that what you would expect out of a stock portfolio?
You know what? Probably, again, it's not 100% apples to apples comparison, because you'd have to take the time into consideration. I would expect less when you talk about real return, because remember now in the stock portfolio, if you sell, right, you're now having to pay your capital gains tax, right? And so that could be a hit on your performance right there, right? Unlike here, a lot of tax savings, as we know, investing in rental properties and so on. And then depending on if you have your LLC, self-directed, and so on and so on. So a lot more tax savings investing in real estate versus investing in stocks. Look, you could have invested in Amazon or Apple or one of those FANG stocks or something like that, and knocked it out the roof. But again, you don't get the tax shelter, you don't get the depreciation that we talk about, right? The whole 5-profit saving center, and you don't have the volatility. If anything, again, if you're thinking about doing this inside your retirement portfolio, you don't like to see the volatility in your retirement portfolio at all. And so that's why I think you see more and more folks, they're making moves out of their retirement portfolio, especially if you take a look at the stock market now and the volatility, and you got this, war in Ukraine going on. We're in a rising interest rate environment. We're in a somewhat political year for later on this year. I mean, there's a lot of cross currents that is affecting the market right now that is more negative on stocks and the stock market than it is on real estate. We got to remember, the real estate holding real estate is a hedge against inflation. Holding stocks is not a hedge against inflation. Now you can start getting sector specific. Okay, I'm going to invest in oil stocks and oil funds and ETFs and so on and so forth. But we know that whipsaws all over the place, right? So So it's just a much more, I think the risk reward benefits you more investing in real estate now, even though in a rising rate environment, but because we're also in this 8.5% inflationary environment versus investing in stocks right now.
Spoken like an educator, like an analyst, like a well-spoken man who knows what he's talking about. Hervé, man, this has been a ton of fun, dude. If somebody, our friends that were with us, we had 30 plus folks here in the community hanging out. We have our friends that are listening in the podcast. If they want to get in contact with Hervé Francois, they want more Hervé on their Thursday. How do they reach out to you, man?
Man, I'll say the best way is hit me up on LinkedIn. That's more, I'm a little bit more active there and things like that. So LinkedIn, Hervé Francois, hit me up. I'll accept your, whatever bat signal in the air or message or like that. We said Batman Robin started at the beginning of this, didn't we?
Yeah,
we'll let the crew decide. But yeah, that's the best way. Probably hit me up on LinkedIn directly.
I love it, man. I really appreciate doing this with you, dude. I told you before the show, right? Like if all things equal, right? Knowing that GC wasn't going to be here, knowing that Brandon wasn't going to be able to be my co-host, I was like, you know what, man? I am really pumped that it was Hervé coming on the show today because I love hanging out with you, man. I love your energy.
Appreciate you, man. Appreciate you.
I knew that this would be a great, great show. I want to thank the community, taking an hour out of your day on a Thursday to just come here and show up and spend time connecting with each other in the chat, spend time asking great questions. Never goes unnoticed on this side of the mic. I want to thank the podcast listening. If you're listening, make a little bit of time on a Tuesday or Thursday and show up. It's a lot more fun.
Oh, yeah,
and definitely. Next Tuesday, you're a syndications guy. Next Tuesday, we got Paul Isajian from Fortune Builders.
Oh, okay.
It's going to give a primer on commercial portfolio investing through syndication. So you may want to check it out and hold his feet to the fire and make sure he's not blowing any smoke up anybody here. But
man, I'll keep him home.
Should be an interesting show. So all right, that's the end of the JWB Rental Property of the Week. Thanks for being us. See you on Tuesday. Until then, be more like Hervé. Don't be average.